Analysts are weighing in with price targets for the S&P 500 for year end. Our guest sees that benchmark hitting 7,000. We're joined by Jay Hatfield, CEO and Portfolio Manager at Infrastructure Capital Advisors. Jay, as always, great to see you. So we're almost at 7,000 right now. You reckon that would put the market at a multiple of about 23 times. Not low, but you say there are reasons to justify it.
Good morning, Andrew. It's great to be back. Well, so what a lot of people forget, they use historical PE multiples, but we had this gigantic cut in the corporate tax rate in 2017, which raised, in our model, raised the theoretical sustainable PE from 18 to 22. So 23 is only a little bit above that level. We think that's justified because the Fed, even though there's a lot of disagreement, is clearly going to cut, at least when we get a new chairman, probably cut in December. That's super bullish. The AI boom is bullish, not just for, obviously, for tech companies, but for some of the real economy, power and real estate. So that should provide extra growth. So we think that a 23 multiple is justified. And we also have a 7,900 target for next year. There is 13% earnings growth expected, a lot of that from tech. So same multiple, though we're not forecasting a big multiple expansion because it is pretty fully valued. And the target should be used both ways. It was a pretty good place to fade the market when we got right around that 7,900 level that you mentioned.
Yeah, so that's interesting. So when a market hits a target, you think people should think, well, do I want to go on owning it?
I'm at 6,900. Yes, of course. And you'll notice when we recommend stocks, we always have targets. So because you can get really burned, as a lot of investors did in the U.S. during this downturn, because they were buying stocks trading at unreasonable multiples of growth rate, like even up to 7 times PEG ratios. And of course, if you invest in things without cash flow, you can get really burned. So targets matter, and it's a great way to avoid really big losses, which is the key to long-term success.
You say that the AI is not a bubble, but you are seeing areas of overvaluation, including some crypto treasury companies that hold Bitcoin, for example.
Yeah, so what's very strange is that there was a need for crypto treasury companies before you had ETFs, because we had a big regulatory roadblock in the SEC to get crypto, or particularly Bitcoin ETFs. So they were filling that void. But then once you get them, why do you need it? Why do you need a levered, more risky opportunity to buy Bitcoin that often trades at a big premium? But then when Bitcoin's down, you lose all the premium, so it goes down way more. So it's kind of an anachronistic vehicle that should go away. It might get excluded from the big indexes, and that might precipitate less of it as well.
What about this battle between Google and its Gemini AI model and OpenAI? Is that an important theme for investors?
It absolutely is. It's driving the trading in these stocks, in the big tech stocks, almost every day. And I would point out, not that we're predicting some horrible outcome for OpenAI, but it is a company that's losing a tremendous amount of money. Its valuations in the private market are 25 times sales versus 7 times sales for big tech companies and about 3 times sales for the S&P. So it's a pretty fully valued company with very stiff competition from Gemini, and it's in the retail market, which is much more competitive than the corporate and industrial market. So that's why you've seen weakness in Oracle and Microsoft and huge strength in Google and Broadcom, because Broadcom supplies chips to Google. So it's creating big movements, as it appears, at least for now, that Gemini is gaining, if not has an advantage over OpenAI.
Can we just switch to inflation? You have in the past argued that inflation in the United States is underestimated by the official figures. Update us on that, Jay.
Absolutely. So it's all about shelter. The rest of the world just uses market rates to determine shelter costs. But in the U.S., first of all, we delay it for 6 months, which is just, gross incompetence or terrible methodology. So we literally don't update it, only update it every 6 months. And then we use arcane measurements of owner's equivalent rent. It's really meant to slow down inflation because we had really bad inflation in the 70s in housing. But what it does is makes the Fed, because they actually slavishly follow it, about 2 years behind. So we adjust it to do it like you would in Canada or in Europe and just use market rents. And our CPI is 1.3 and our PCE core is 2. So they're just using the wrong data. So we need a reform of the Fed. Hopefully a new Fed chair will come in and produce a new framework so that we don't have this terrible policy that's behind the rest of the world and holding back economic growth.
And you're no fan of Jay Powell. Tell us why.
Well, just for exactly that reason. But there's another element, which is a lot of investors don't recognize this because everybody was trained in Keynesianism, which is, I would argue, is more of a political theology. But inflation comes from the monetary side. It's excessive growth in the money supply. During the pandemic, it grew 60, nominal GDP 38, and of course, inflation is 22. So Milton Friedman was proved 100% correct. But this Fed chair doesn't believe it matters at all, which is just malpractice and led to the transitory theory of inflation, which was 100% wrong. So one of our worst Fed chairs since World War II.
Okay. Are you buying U.S. government bonds these days? Maybe you'll put up the 10-year bond yield. I know it depends on your holding period. Say you had a holding period of 5 years. Would you be buying 10-year treasuries?
We would. I mean, we don't trade a lot of treasuries. We're implicitly buying treasuries because, our largest fund, PFFA, is a preferred stock fund. So it's fixed income. So half the return comes from the price of treasuries. The way to trade U.S. treasuries, at least, if not in most countries, is it trades 100 over the terminal Fed funds rate. So where the market thinks the Fed funds rate is going, it's traded that nearly 100% accurately. And so we are bullish that the Fed will cut rates because inflation, even measured inflation, is going to come down because finally those indices are tracking our index. So we think we'll get to, we'll have a pretty big rally in a 10-year, but not huge, probably down to the 375 level. 275 is our estimate of the terminal Fed funds rate. So a little bit of upside for investment-grade bonds and treasuries. We think more upside for riskier fixed income like high-yield bonds and preferred stock.
And just finally, the U.S. debt. Is there really ever going to be progress on that? The massive overspending and accumulated debt. Is there any hope politically that the parties will get serious about it?
I would say no, but there is the one exception you referenced, is that at least for now, the president in the U.S. can impose tariffs, which is not just unpopular north of the border, but really unpopular with consumers and many, many companies. But he has done that, or the administration's done that. That's $400 billion of revenue. That's a lot. That's almost 1% of GDP, and it's going to reduce in our models our debt to a sustainable level, our deficit rather, to a sustainable level at 4.5%. We're growing nominal GDP at 5%. So that our projections show a gradual decline in debt to GDP. But for those tariffs, though, I would say there's close to 0% chance of any fiscal responsibility because we don't have a balanced budget framework in the U.S. for the federal government. And politicians want to get reelected, spending money and cutting taxes is popular, raising taxes is very unpopular. So you never get any fiscal discipline unless it's imposed by the administration, which really is only tariffs.
You're a guy who likes to go against the grain where appropriate. For decades, we've been told, theory of comparative advantage, a multilateral free trading framework globally is great for everyone. Do you think, is there a nuance there? Have we been sold a bill of goods? Should some protectionism be imposed?
Well, I would distinguish between trade wars, which, to be fair, at times the U.S. has been pursuing what looks like a trade war with Canada and definitely with China. So I think what you're referencing is absolutely true with regard to super high tariffs. Having tariffs in the 10 to 20% range is much more like a sales tax and isn't probably enough to really drive comparative advantage and the efficiencies, and can be easily arbitraged away. So we're in favor of modest taxes, really on other things as well, like pollution taxes, instead of just taxing corporate profits and wages, which discourage work and investment. So, but we're not in favor of these huge taxes that have been imposed and are being imposed, as you mentioned. They're really close to uneconomic on some raw materials like steel and lumber.
We'd better go. Jay, thank you very much indeed.
Thanks, Andrew. Thanks for having me on.
Jay Hatfield, thank you. CEO and Portfolio Manager at Infrastructure Capital Advisors.